2015 was very successful year, and thanks to all of you who attended our events. We organized 29 of them with 83 speakers and over 7,000 attendees. We have all our upcoming events listed on our website, hivedata.com. We have almost every week one event. So February was busy, March is going to be busy as well. As you know, Hadoop is turning 10, so we'll have the cutting speaking in March. All of them on our meetup page and our website. Without them, with our partners and sponsors, many of our events wouldn't have happened, so we'd like to thank them as well. What Hive is and what we do, more from managing partner and then one of the co-founders, Kieran.
Thank you, Sasha. So Sasha used to work here with Scott Robinson, so I'm sure it has a special meaning for you. So the Hive is a venture studio, so we are a co-creation entity that helps create, fund, and launch companies. We are very focused on data and data-driven applications and use cases. I'll figure out how this goes forward. Down. So you can see some of the areas of interest for us. So think about us as using machine learning, analytics, deep learning approaches, across a broad set of categories. And so blockchain is one of our important areas of interest. You're going to hear Adam from Blockstream talk today. There's another company here that you should check out called Coinalytics. And Coinalytics is providing real-time intelligence and analytics for blockchain systems. Coinalytics is hiring, so if you're interested, please reach out to me or to them. We have a company called Neva that is creating software robots for robotic business process automation in enterprises, and creating various kinds of autonomous agents, virtual agents, based on NLP, deep learning techniques like that. So if you're interested, reach out to me. I hope you'll tweet tonight's event. Use the hashtag #HiveData. And with that, I'd like to just have Scott Robinson, the host for tonight's event from Plug and Play, who's also the head of the FinTech group, and say a few words.
Perfect, thank you. All right, so thank you all for coming. Who's here from the Silicon Valley Bitcoin meetup? Okay, good showing, fantastic. For those of you that aren't familiar with Plug and Play, who's here for the first time? First time, straight. So Plug and Play is a startup accelerator investor. We run a number of different programs. Actually, the program I run was born out of this Bitcoin meetup about 2 years ago. So we're very excited to have one of the premier teams, engineering teams, speak this evening. But for a quick history, we've made investments in companies like PayPal, LendingClub, and Dropbox. And I work with a large consortium of financial institutions like Deutsche Bank, Santander, Intuit, folks like that. So we've made about 11 investments in the blockchain space specifically. So we're excited to work with the Hive to host this event. We're not competitive in any way. We often are fighting perhaps for the first check, but the Hive has brought significant value to the space. So I'm sure folks that thought of it can really see consensus around. So with that, I don't want to take any more of your time. If you have questions about Plug and Play or the FinTech program I run, please come shake my hand, and I'll pass it on. Thank you.
Thank you, Scott. I really appreciate So for those of you from the Bitcoin community, Adam that needs no introduction. So he's the co-founder, president of Blockstream. Blockstream is enabling Sidechains. I'm not going to say much about Sidechains because he has a whole talk about it. He's world-renowned cryptographer, creator of Hashcash, a system, proof of work system that has enabled Bitcoin. And we are fortunate to have worked with Adam and be a kind of a small investor in Blockstream. So with that, I give you Adam. We'll have a Q&A session after that. Adam needs to leave about 10 minutes to 8. So if you do have a question that's very kind of pertinent to what he's saying, you may ask it at that time, but otherwise please go to that time. Thank
you. So just starting with some overview Bitcoin versus fiat. So I know it's a technical audience, so I guess we'll go through this stuff quickly and get onto the more interesting topics. So Bitcoin seems to have been born out of a period of quantitative easing and problems in the central banking world, where there are moral hazard, hyperinflation, capital controls, actually slow settlement. I mean, people typically experience a reasonable transfer time, but often there's a long revocation period where things can be undone. So the settlement is not final for extended periods of time. Even credit cards can be undone months later. Nick Szabo had made the observation that transfers are much more complicated and slower and less reliable once you go across international borders to different countries. Another major difference is, it's a feature of the banking system that it's based on identity. And actually there's a kind of connection with Bitcoin and Hashcash mining that goes back to focusing on the problem instead of identity. So sometimes you see systems that are insecure, and people will try to repair the insecurity by identifying people so that if they exploit the insecurity, they can be punished. And this has been a trend in many kind of IT areas of security. So the one that was concerning me at the time was I was running an anonymous remailer, so something like Tor, but for sending emails many years ago. And people would send spam through it and make it difficult to use it and use a lot of resources. And so the remailer, however, is intentionally anonymous. So we can't punish the sender, we can't identify the sender or remove the purpose of doing this. So the other thing then was to focus on the problem. So what is the problem? The problem is there's no cost to sending email. So then I looked at some hash collision technology and was seeing that a full hash collision is very expensive to compute, virtually impossible within 100 years or something. But if it were to be found, it would be very easy to check that you had a full collision. So that concept connected with the root problem is there's no cost. And so then I just found a way to sort of scale the cost, tune the cost at will. And so at the time with Hashcash payments, there were 20 bits of leading zeros, and so about 1 million iterations, and Bitcoin has grown a lot further. It's like 70 plus leading zeros, which is an immense computation. So Bitcoin is also focusing on the problem and not on identity. So in a sense, Bitcoin creates a tokenization of assets, so Bitcoin assets, but when you extend blockchains into being able to support other kinds of financial instruments like shares and bonds and so forth. The interesting property you get is a sort of bearer property where you can own and control an asset based on a private key, and there's no identity in the picture, at least at the settlement layer. So people may add identity if they connect this technology into an application, but they would add it outside of the settlement layer, because the settlement layer is broadcast and intentionally compact. So you wouldn't want to send XML fields or X509 certificates because it wastes a lot of bandwidth. So that's one of the interesting things here. And it's global on permissions. Okay, so that's good. Yeah. No, it's a similar slide. Yeah, so I mean, with banks, you have basically it's very simple. They all have a database record with user accounts, which is based on identity, and a balance for the users. So if you think about how to secure this, it's the weakest link in the chain problem that each and every bank has to have, audits and security around their ledgers. And it's possible for any bank to basically, a system administrator of a bank to go into a ledger and change the balance and then be able to spend money that was just created out of nothing. And this actually happens from time to time. A few years ago, I think there was an Indian bank where somebody broke into a data center where the machines that kept the balances for some prepaid cards were kept, and they added $45 million to cards, and then they went around with a gang of people and withdrew cash. I don't think they got it all back, but they managed to cancel the cards before it got very far. So you have that sort of problem. Whereas with Bitcoin, it's the token itself is secure. And what makes the token secure is that the chain itself is uncensorable. So it's an interesting concept that if we talk about a regular ledger, we could have some passwords to access your bank account or something. But ultimately, what you have is an IOU from the controller of the ledger, because the person who's controlling the ledger can edit the ledger and revoke your ownership effectively. Whereas with Bitcoin and blockchains, the ownership is, you have the keys, and basically it's very difficult for somebody to change the ownership, because even though the information is broadcast on the network, so you don't actually have control of the data, the fact that it's sensor resistant and distributed means that you have effective ownership, because anytime you want to transact, somebody will process it for you. So the fact that it's decentralized is what makes it better, and also what makes it secure and tokenized, so that you can send it over open networks, and that opens also the possibility for permissionlessness. And we like permissionlessness because that's credited with the burst of innovation that came with the internet, moving from billions to nothing in bits. So, that's good. So now we're going to talk about sidechains. So, the Bitcoin blockchain. And it has very interesting features, so smart contracts and this bearer digital token concept. But it only supports Bitcoin. So the types of smart contracts you can write are sometimes not so interesting, because you can write a post-dated check, and you can write transactions that have multiple signatures and some threshold. But there are much wider applications in finance with shares and bonds, and once you get into more advanced products, they actually have small, if you, instead of representing them as legal contracts, if you could write a program to execute them, you can implement derivatives or structured products or other financial instruments as smart contracts within the Bitcoin system. So we'll talk more about that in a bit. The finance system tends to have slow settlement, and this is because there are multiple parties involved, and information can get out of sync, so they are sort of after the fact doing reconciliation. And with a blockchain, it's basically more instant. final settlement. And that's partly because it's a single system. So the final system is made of disparate networks that are connected by various protocols, and then settlement processes, reconciliation processes between them. Whereas with Bitcoin, even though it's decentralized, there's logically one store of the data. So if you have ownership in that ledger, there's nothing else to reconcile it with. That's the ledger of record. So as I say, the Bitcoin blockchain is only directly able to support Bitcoiners. Obviously, we also sort of shoehorn additional concepts into it with watermarking of color coins, and a number of people have experimented with color coins. So at some point, years ago, I started to wonder about extending Bitcoin. So I developed a few different ideas for improving fungibility or extending it, and there is a whole list of interesting ideas that people have collected on the Bitcoin wiki. It's the Bitcoin wish list, you can find it online. And however, it's changes to the Bitcoin chain have to be done cautiously because there's a lot of value in it. It's to undergo rigorous testing. So it's also difficult to imagine the main Bitcoin chain taking on a lot of experimental features or a lot of features that don't really focus on Bitcoin. Let's say share issues or something. So then the question is, well, if we want to make the useful features of Bitcoin available for these other types of transactions, how do we do that? How do we extend it? So that led to the concept of a sidechain. So what a sidechain is, if you're familiar with altcoins, it's a chain with its own mining and its own coin. So with a sidechain, we can make another chain that's kind of like an altcoin, except it has no native coins. And then the question is, can we move Bitcoins into it and back out of it? And it turns out we can do that with reasonable security. And I'm going to go and describe how that works in a bit. So there's a mechanism to move assets, which is also being called a two-way peg. And for the simplest case, you're moving a Bitcoin from the Bitcoin chain into a sidechain, and then the sidechain will have some additional features or extensions. But the mechanism to move an asset is generalizable, so you could also use it to move an asset. You have multiple sidechains, and you can use it to move an asset from one sidechain to another. And the asset wouldn't have to be a simple asset like a Bitcoin. It could be a smart contract that is a derivative between Bitcoin and gold and dollars that's written as a smart contract within one chain. And you should be able to move that contract into another chain as an object that isn't necessarily basically understood by the chain. So you could have one chain with one smart contracting language, and a different chain with different smart contracting language. And it's common in the finance world that they will buy an instrument, a simple instrument made by a different financial institution, and combine it into a new structured product or basket instrument. And so what that allows is people to move assets around. So when it's been moved out of its native chain, it won't execute it, but you can trade it and trade assets based on it. And if you need to have it execute, you move it back to its chain. So the interesting possibility is that there's been a lot of interest in blockchains with various security models, some of which are based on trusting a threshold of signers or are centralized, and some with mining and so forth. But it's interesting that they should be interoperable. So with some of the current work on blockchains within banks and financial institutions is to try them out as a proof of concept or a pilot project where they're not interconnected with other institutions. But once it gets into real life use, financial networks are very interconnected and the products are moving between companies. It actually becomes I mean, the most interesting part of blockchains is that it can automate trust, so that you can receive an instrument and not have to trust the issuer very much, or not have to trust the person who wrote the contract. So, because the blockchain is going to execute the contract for you. So, if you had two different banks with different blockchain technology, and then they come to realize that we need to sell this financial instrument to the other bank so they can build a structured product from it. If the chains are not interoperable and there's no way to send that while preserving the trust and security properties, it's lost much of its value. So I think blockchains add more value between the institutions, which is where trust gets more complicated than within an institution. So I'm expecting that the interoperability will become much more important as things progress. And so sidechains, apart from providing an extension mechanism, they define an interoperability standard. We're going to talk about some uses people have made of sidechains in that way. So this is just showing also an additional type of use case. So the main blockchain will have the peg mechanism to move assets between chains. This is just moving Bitcoin here. And you can have different chains specialized to different purposes. I would say generally you would expect not too many chains because it's easier to write smart contracts when you have multiple instruments types in the same chain. So one question that comes up when people try to follow what's being extended is that in Bitcoin, all of the instruments are mined because they're all Bitcoins. And in this sidechain, if somebody's issuing shares, the question is, do they need to have some Bitcoins to attach the share to watermarking or coloring? And do they need to mine to create Bitcoins? So, in fact, what happens is there is a new type of coin-based transaction. So blocks can have not just the main Bitcoin generation transaction, they can have a user-defined coin-based transaction which defines and creates, let's say, a share issuance for a startup. So, and it will introduce a key that is the startup's mechanism to sign and create new coins without any mining cost. So, with the sidechain that we've implemented, it's no longer watermarked or colored, it's natively understood. So there is an extra field that defines the spike. So then within the sidechain you can have Bitcoin still because they've been moved into it. But you can also have various user-defined spikes that correspond to different share issuances or bonds or even the US dollars if somebody's holding onto the underlying asset. Another interesting potential use of technology to the left is this data release. And what that's saying is that when changes are made to Bitcoin, it's always in a live system. So it's a test net, but it doesn't have any value on its net. So in an operating system sense, you have a similar to the Red Hat ecosystem. There's the Fedora, which is changing more frequently. It's not quite as quickly tested and validated against different applications. And then the Red Hat Enterprise one, which has more validation and testing. And you switch, technology comes into the main chain, or you develop it goes through a life cycle of alpha beta and then it becomes stable or something. So it opens the possibility that could be used as an upgrade mechanism for Bitcoin itself. So we could have, instead of a series of incremental careful changes, we could have some more wide-sweeping changes within the sidechain that do more major refactoring or format changes, and then get experience with that in a beta form, where people who need early access to those features could use their beta chain and have value circulating in it, and once confidence is achieved that it's quite robust, that could be promoted to be the new main chain. So, cover all of this. So now for some technical detail about, so I talked about moving assets between chains, so a little bit of the case of moving bitcoins from the main Bitcoin chain into the sidechain. So first step is you suspend the Bitcoin, so you prevent them being traded for now on the Bitcoin chain, and you present a proof that you suspended them to the sidechain. So in Bitcoin, so the way you prove things is the same as the way you prove to an SPV client, like a smartphone client, that it's received a Bitcoin transaction, which is you show it, so the list of headers of the hash chain, and then a local tree path to the transaction itself. So if you suspend the Bitcoin, you're marking it in a way that the sidechain will know that if that sort of marking is being mined in Bitcoin, it won't be tradable on Bitcoin. So present that proof to the sidechain, and then the sidechain activates it on the sidechain. You can use it in a normal way with whatever extensions on the sidechain. And at some point, somebody, the current owner, decides to return some of the coins. So there's a similar process there where it's marked as, it's basically deleted, not been frozen. And you send a proof that it's been deleted back to the main chain, and that is used to unsuspend the same number of coins. Now there's a maturity period where it's kind of like when you mine fresh coins, they can't be spent for 100 blocks or something. And so there's a similar kind of maturity period. So this is relatively slow. And the point is that during that period, somebody can contradict the claim that you're moving coins back. So there's security reasons for doing that, which is roughly that the main chain is not sort of directly aware of all the transactions on the sidechain. So if somebody presented a proof, it doesn't have a way to directly know if it's the longest one for certain. So by having a maturity period, other people can come and present a longer chain, which would cancel the fraudulent attempted return cancel. So after the maturity period, the coin is reanimated and can use other Bitcoin. So that process, the same kind of process can be used for other assets between chains that support extensions. So then the question is, okay, so how would we go about making this change to Bitcoin? So there is, Bitcoin has a programming language. So the first question was, well, is the programming language expressive enough in order to directly implement it as a complicated-based script? And it's close, but not quite, we think. It's kind of fun exercise that maybe with some clever abuse of opcodes and a big massive chain of scripts, perhaps it might be possible, but nobody's put that together yet. So the simplest and most elegant way to do it would be to introduce new opcodes. Now, interestingly, this is a soft fork. We don't need a hard fork to introduce this. One of the things is the proofs coming back can be quite large, and so there's a new concept introduced, which is a compact proof of work for, so you have the hash chain with a whole list of blocks, and you want to prove that a given transaction is in the same chain. And you want to do that without sending all of the headers. So you can do that with a skip list. So with each block, you point back to the previous pirate 2, and the next pirate 2, so 2, 4, 8, etc. Then if you can skip your way back to the header and only send the ones that you land on, you can do it in sort of login data, generally speaking. And then the other thing is you want this proof to preserve a proof that much work was done on the chain. And the way that that's done is quite clever. So when you do the proof of work, it's a stochastic random process, right? So if you've reached Bitcoin's target of 70 leading zeros, even though that's the target, half the time there'll actually be an extra zero, and a quarter of the time there'll be 2 extra zeros. And so we can use that extra zero to authorize use of a deeper skip list. Okay? Now if you think about that, if you're presented with this compact proof and you want to forge it in less work than producing that whole chain, you can't, because if you actually need 72 bits, it's going to take you 4 times as long as finding 70 bits. So there's no gain to be had by forging the stateless versus forging the full chain. So it's a clever way to make a more compact proof that the coin is in the same chain. So the next question is, what does this kind of neat extension mechanism do to security? So in Bitcoin, the security model is, in part, it works because people want it to work. I mean, that's the way their finance system works. It's actually very insecure and surrounded by firewalls and different things. So, but with Bitcoin, it has this novel security model that, basically there's a single supercomputer that is moving into the future faster than anybody else can catch up with. And as long as there's something like over half of the people are honest, then that will be secure. So it's quite an unusual security model because the advantage, there's not really any advantage, computational advantage between the attacker and the user. So normally with single server eCache protocols, they will be based on digital signatures or something, and you know that if the attacker doesn't have the private key, the cost to steal the coin will be huge and completely infeasible. But Bitcoin doesn't, it has signatures for sort of claiming ownership, but in terms of the ability to unwind transactions, which could be a way to commit fraud, the security model is quite unusual. But it works well enough, and people have come to trust it, and there are many, so when I said that it works because people want it to work, is there are miners who are investing in Bitcoin and businesses that want Bitcoin to succeed. So there's enough kind of incentive to see the system succeed. And also there is a financial incentive. So the incentives in Bitcoin is set up so that it's generally more profitable to mine than to try and commit a fraud with some mining equipment. But even that assurance has limits because it depends, if you're, let's say you are 20% of the hash rate, and you need to commit a fraud, you would need to produce a chain that's 6 long, so then you have 1/5 chance to the 6. So very infrequently you would manage to do that. And so you would, by doing that, you'd be producing invalid work. So the cost would be you would lose many blocks until you succeeded. But it still says the security model is that if you were able to, target $1 million transaction and pay it into an exchange and take it out in some other form, get into the wire transfer out or take it out in a different cryptocurrency, and then have the small chance of unwinding the transaction and keeping the coins, maybe that could still be an expected positive value attack because the reward is not big enough to counter the size of the transaction. So Bitcoin has this problem as well. With the sidechains, it's similar and arguably slightly worse, but it's essentially a similar security model. And the one way to look at it is, in order to steal coins from the sidechain, you would need 51% of the hash rate or some variant of that. And if you have that enough, and you would need to maintain that for the maturity period, so effectively a day, and if you have that amount of hostile intent hash rate on the Bitcoin chain, you wouldn't be able to take all the coins, but it would be a very disruptive event, and could easily take a lot of money from exchanges. Exchanges might go bankrupt, so it would be a pretty catastrophic situation. Another possible security model is the Federated sidechain. So Federated sidechain is where there are a group of signers that make a multi-sig to approve transactions, and it can be possible to combine a federated signing threshold with mining as well, so that the signers have a 40% influence in which transactions are valid, and the miners have 60%. And so that does get interesting. it maybe creates a system that is more secure than either in isolation. So the thing I didn't mention there is that a way to repair the incentive is you can, so in Bitcoin you've got the subsidy, so the Bitcoins that you're mining 25 Bitcoins every 10 minutes, and that's what provides you the incentive to be an honest miner. Now, and the sidechain doesn't have that incentive. Now, let's say the sidechain was a beta Bitcoin, okay, the next version of Bitcoin. You could make a consensus rule that half of the Bitcoin subsidy from a Coinbase transaction had to go directly into the sidechain, and that would ensure that you can't, honestly mine Bitcoin to collect the reward while simultaneously attacking the sidechain. So it's merge mine, because you would then lose half the subsidy. So you could allocate subsidy, and you could make that a consensus rule of the sidechain. So the sidechain, if you didn't transfer half of the subsidy into the sidechain in Coinbase, then merge mining would be invalid. So that would prevent people. It would normalize the security so it would be closer to everyone. So we're talking about the major version use case of the sidechain. So use it as a software upgrade, do major refactoring. After it goes stable, you could migrate the coins across. And users who want the features early can use that. And that can be safer than making basic changes on the live change. And perhaps we could use it as a mechanism long term to get to a faster development cycle. And then apart from a basic chain, you can have lots of different chains doing different things, and some people have started to work on those. So other than extending Bitcoin, you can just use the interoperability mechanism and completely replace the logic of how coins are tracked. And so Rootstock, which is a startup, has been working on that, and they were able to port the Ethereum script language into a sidechain so that all of the currency and fees are paid in Bitcoin instead of the Ether coins. And so that's a reusable concept. So if people develop interesting app coins, they can generally be ported into a sidechain. So that means it essentially sort of decouples speculation from features. So we can do experimentation directly on Bitcoin without introducing new currencies. Something else that could be interesting is zero cash. So zero cash is using some interesting cryptography and has some failure modes if the cryptography fails, such that and the proofs are big, so it has all these different trade-offs. So it would be difficult to expect those to get put into Bitcoin directly, but they can more easily go into a sidechain. So there's a zero cash project now. I think that may not be using sidechains yet, but it could once it's ready. And snarks are very interesting as well. So this is the succinct, non-interactive argument of knowledge. And it proved it's a very sort of full logical extension of the concept of a signature. So I guess one way to look at it is that the Bitcoin scripting is a kind of signature. It's a signature that may contain digital signatures as part of it, but it's basically the trace of the program. So with a Bitcoin script, your challenge is to provide inputs to the script, so inputs to the program to make it return true, and if you can do that, then you can take the coin. So if you think of that as an extended signature, it's a signature around a program. And however, the way that you verify Bitcoin scripts is you run them again. You take the input, and so somebody sent it to you and said this returns true, and to find out if that was actually correct, you rerun the script. So, and if the program is complicated, there'll be a lot of input and a lot of computation to rerun it. And so what snarks do is they provide a compact signature that proves that the program was run without you having to even run the program. So it's a signature that proves execution of the program. And it's a very powerful concept. It's used as it's a relatively new cryptographic primitive in the last few years. And it's used as a building block for doing zero cash And so it might be interesting to even have a sidechain that is built to explore snarks. So it has the snark primitives in there, and maybe allow snark contracts that don't even reveal the programs. So the high inputs and calories. So there's another project called Lifeline, which is a prediction betting kind of chain. The Elements sidechain that we released at Blockstream is it's an extension of the Bitcoin that I described earlier. So it has issued assets for confidential transactions, which we'll talk about in a bit. Okay. I'll keep talking. So yes, so Elements project has a number of features: issued assets, confidential transactions, which we'll talk about in a bit, and support for currently the Federated security model, so a group of signers that will sign the transaction, and in longer term, the peer-to-peer sidechain that I described earlier. We'll get into that, and that will introduce then merge mining possibilities. So the sidechain mechanism itself is surprisingly flexible, so that you can actually change surprising things about the behavior of the sidechain, even though it's connected. So you can have different parameters, different scripting languages. The fact that you can do Ethereum or zero cash in there shows that very alien concepts can work. So the way that the coin ownership is tracked can be completely different. That doesn't really matter. And you can even change the block interval, potentially even change the hash function while using an indirect chain to translate. So you can change the block size, which is a hot topic right now, but I want to stress that the sidechain extension mechanism is primarily not a scaling mechanism, because when we're talking about scaling, we're talking about the amount of data that has to be received, and the amount of computation, and the convergence time of the consensus protocol. And by putting it in the sidechain, it doesn't change those fundamental limits. So you could potentially somewhat push a sidechain. So if it was a chain for low-value transactions, perhaps you could push the parameters a bit harder than you want to on the main chain, so that it ends up being less secure or more centralized or something. And perhaps people will tolerate that for low-value transactions. But I think the real, to actually scale Bitcoin, we need to move to layer 2. Yes, yeah, we need to move to the layer 2 protocols like Lightning and the duplex microfluid channel, which improve scalability, and I'll talk about Lightning in a bit as well. So, Blockstream recently has announced the liquid sidechain. So it's built using the Elements project source code that is public, open source on GitHub. And what the purpose of this one is to connect Bitcoin exchanges. So if you've ever tried to do arbitrage or move deposit coins into an exchange to sell them, you will see that they often want you to wait an hour before you can sell the coins. And so because the liquid sidechain, the Elements project is using federated signers, the block interval can be very short, and it's a small group of, so we can potentially clear blocks in a few seconds. So the exchanges themselves run the nodes, so some subset of the exchanges are acting as the threshold signers for transactions. And so let's say there are 8 exchanges, you might have it so that 5 signatures out of 8 in the multi-sig have to be present for transactions to clear. And that's a trade-off between security and availability. So if somebody has a network failure, you don't want transactions for everybody else to stop. So the fact that there are less than 8 gives you that resiliency. And the current implementation the implementation supports more things, but the current rollout is focused on moving Bitcoins, but the same technology supports the underlying Elements project supports user-defined issued assets. So the obviously useful thing to do in this context is to have the exchanges or a separate issuer be able to move their US dollar or euro balances into a blockchain format. So they'll be able to move those quickly within the chain. And actually, if you try arbitrage, the worst problem is the transfer in and out of fiat. Depending on which country is international, it can take up to a week basically. And it's quite problematic. And in the past, that has affected pricing. You can see that the price will fall and you'll wait a week and you'll have a balance, or just waiting until the transfer is cleared to buy. So if we get faster liquidity, we can probably smooth some of that out. The other thing that people do with arbitrage is they deposit money in multiple exchanges and then wait for buying opportunities. And so that ends up slowing down the amount of arbitrage they can do because they have to split their money up into little separate little piles. And so they still can't do as much arbitrage, or they can't make their capital work as hard as they would if they could move it quickly. And the liquid session is using confidential transactions, which we'll talk about, which provide increased privacy that hides the value of the transaction. And that's interesting because it will help prevent front running. I think there have been cases where people have figured out exchange deposit addresses and watched on the blockchain for what's going on and used that as a signal to front run something. So it's interesting the trading that we can prevent that. I think we've talked about a lot of this. One way to look at the smart contract execution is that it is a virtual narrow AI, so it's perfectly honest automaton that will execute a contract. And so that sounds like maybe science fiction, but the way that it works in practice is that every validated unit in the network reruns the contract and checks that it executes correctly and that it corresponds with the claim. So the miners prove that, and anybody who wants to validate the network as a full node can also play along and check that everything is correct and with a proof if it's incorrect, or reject and not rely on it if it's incorrect. So I think the other properties we covered earlier, so I think what you lose with a federated chain versus a blockchain with mining is that the main thing is that if it's a federated chain, you have an IOU from the controllers of the ledger, which looks a lot more like the status quo. So it's not really a veritable. It's just a claim on the chain limit. They can choose to not honor the claim. Whereas with mining, you have something which is secure and tokenized. And that's interesting for the next point up, which is that if you have a federated chain and you move assets between different federated chains, it's we're familiar with X509, it's really kind of like the cross-certification of CAs. So if an organization has a CA specific to that organization, and they want to interact with people in a different organization, they have to get their lawyers to look at the certificate practice statements and agree that they will accept the change of practices, and then authorize that. So it's very manual in checking that they are happy with the audit statements and solvency of the other group of federated chain operators before they will accept the strings coming from them. Now that's because the chain operators, if they were all colluding, could rewrite history from the beginning and no cost basically. So they can tell you whatever they want to tell you. Whereas with mining added to the chain, sidechain or blockchain, it becomes trustless because you've got this independent and evaluatable proof that this happened in a certain sequence, and it would be very hard to revise it. So it's still relying on the single fastest supercomputer model, where you know that there's only one computer that executes this, so this must be the true record. So that gives you the trustless chain transfer, which is actually where a lot of the value comes from, because managing trust between institutions is where the costs come. So I'm going to talk about how you go about mining sidechains. So we're just describing mining is about immutability, like permanence of the record. And so in banks, they will sometimes use various pieces of technology or procedures to ensure that their ledgers are immutable, because they want to prevent fraud and cross-check. And so there are, for example, large storage arrays you can buy, which are certified as evidential. So it's relatively hard for the operator to delete data to look at the right once mechanism really built for normal rewritable disks, but it's given an interface that meets all that needs and some temporal resistance. So I'll go on to federated sidechains. So there it's there's a threshold of signers we just described, and the signers may be using tamper resistant hardware, so that it's not so easy to change, to override, even if you have an instance of a rogue system that goes straight to start to take funds. And if you add the merge mining, that's where miners can provide this independent security. How am I doing for time? Okay. So, and then they also mentioned the possibility of a federated model in a hybrid with miners as well, and that could be interesting. So, the permissionless nature of blockchains is very, very important, I think. There is a use case for blockchains inside organizations and so-called permissioned blockchains, but really, if you look at the internet and said that, well, each organization that liked the internet technology, they would make a LAN with an incompatible, non-connectable protocol. Internet applications really wouldn't have taken off as well, because it's the network effects of interoperability that gives NetCastle and the scope for lots of people who are building startups to go innovate with it. So permission chains are good, but they are ultimately data integrity tools for existing closed networks. And if that's the extent of what happens, it doesn't add permission, and there's a high cost of entry because of regulation. So financial institutions sometimes get themselves into a business ecosystem where it will be against their financial interests to admit a new player. So effectively exclude new players. So that makes innovation difficult. However, it is a high cost of entry, so it's much harder to start a bank than it is to start a new web service or a new social media app because of the regulation and the complexity of the interconnects and technology and so on. So probably one path forward is to look at new use cases. So types of transactions that are not well served by the existing financial institutions because they're in countries that are underbanked or they're in grey market areas where people find their accounts closed frequently, or the values are much lower, or the settlement periods are much faster than normal, or where fraud costs are high. So some types of internet payment software are very high, credit card fraud rate. And so Bitcoin settlement is immediate, can be more immediate and final. You can get lower fraud rate. So I think the interesting thing with blockchains is that they provide sort of real-time audit, so they prevent fraud happening rather than try to deter it. So if you look at financial regulations, in principle they're rooted in consumer protection from various things that went wrong in the last century with stock scams and bank runs and various things like that. So, and still even today, see quite frequently banks being fined from pending loans and doing various things that are defrauding somebody. For say they're liable or leading, there's usually something to do about multiple times per year, often a new scheme each time. So regulation is good, but it's not preventative, it's a deterrent. And the side effect is that the regulation creates a barrier to entry, and that stifles innovation and results in high fees and margins for the banks. So I think there can be a case that could be made for non-custodial blockchain technology. So the user has control of their own keys. Then some kind of blockchain business that's helping users with their own keys doesn't actually have custodianship of the coins. So you could make a case that there's much less scope there for the financial institution to do something inappropriate, to take the user's funds or borrow against them or gamble with them, because they would need the user's explicit cooperation in order to do that. So that can be a way to provide low regulation innovation. And I think the California regulations talk about non-custodial potentially in a separate way to custodial services. And if this kind of technology eventually is rolled out, more financial networks are brought into it, it could also reduce systemic risk because everything is audited and prevented up front within the rules. So let's talk about this. So it's also possible to enforce, so Bitcoin enforces some rules. So one thing in 21 million maximum coins. But inside its chain, you can potentially enforce other rules. So if a type of instrument has some leverage or capital requirements, all of the components are trapped in the chain for potentially make that chain enforce the rules. So in that case, a wallet that's tracking this chain would improperly enforce that let's say, the banking leverage ratio is not exceeded. So today, that's actually typically not enforced. They will go look at it at the end of the year, and maybe they will move it for a period of the year, and that's how banks go bankrupt. They went over and they hoped they would recover, and they didn't. And by the time the auditor gets in, it's too late. So, all these things are interesting, but we want to scale very far, and direct on-chain scaling has some fundamental limits because of this broad cost between all those, so you get some kind of ON squared scaling properties, with also a larger portion of light clients that are relying on this model, what Lightning does is, in the duplex payment channels are similar, is it provides a cache layer, so a write caching layer in discipline, so that many transactions can happen in the cache before they actually get written down to the blockchain. Also has a side effect of making faster zero-confirmed transactions, so you can get one if you accept an unconfirmed transaction and it's not yet in a block. The security is quite a lot weaker. And so for high value payments, people usually wait for the confirmations, which makes them slow. With Lightning, you can achieve arbitrary sized payments, subject to capitalization in the network, with instant final security. And basically, the Bitcoin blockchain in that model for Lightning payments at least becomes a sort of dispute resolution mechanism where if you use some funds on a node that is supposed to provide service to you, and it drops off the network and your funds are frozen, you can take, don't come back for a day or two, you can take it to the blockchain and reclaim it. Okay, we talked about smart contracts. So, just talk briefly about files. So, confidential transactions. So this is the thing I mentioned earlier that you can, it's kind of a counterintuitive result, but you can encrypt the values in the blockchain in such a way, so if you straight up encrypt the values, is the problem because people can encrypt very large values and create money. So if you encrypt it in a particular way with homomorphic encryption and some zero-knowledge proofs, you can arrange things so that a full node can validate that the values add up, even though they don't know what the values are. So you can, this sort of commutative property that you can have encrypted 3 and encrypted 5 and see that it adds up to encrypted 8. You've got full auditability, that's the case, but you don't know how much money just change hands. So we've implemented this in Sidechains projects, and it's being used in Liquid projects as well. And so normally only the sender and the recipient get to see the values. You could optionally disclose the keys to an auditor or an accountant or something. So I'm going to start skipping a little bit because of time constraints. Okay, that's it. All right.
We can take a few questions. He has to catch a flight and get into the airport, and this weather is going to be rough. So Sasha has a microphone. Oh, perfect. So Jeanette, if you just raise your hand. That's one way.
Thank you. Thank you. Since there are going to be many sidechains and there will be competition, I'm just curious to know how we can distribute that merchant money and how we can assure that decentralization and protection from 50% attack can be achieved in this way. So can it be the risk of fragmenting the mining power and how we can trust which sidechain?
So, okay, I mean, there's a couple of concepts there. One is that you can merge mine multiple chains at once. So, so Namecoin was merge mining Bitcoin, it still is, and for a long period of time had 80-90% merge mine ratio. So reasonably high hash rate. You don't want to have, a small hash rate. If there's only 10% hash rate of Bitcoin, then obviously there are a lot of potential combinations of parties that could attack it. So you need a high merge mine ratio. But the merge mine mechanism constantly work. There are ideas about how to extend it more elegantly to merge mine mini chains at no extra competition, negligible extra computational cost. So the main cost is receiving and validating transactions, or if you're using a pool, the pool will do that. So, but the chains, block interval and orphan rates are independent because when you're mining, they may even have different difficulties potentially. So, so you may need more network equipment and faster networks if you're, if everybody is basically mining multiple chains, there's more data moving around. So in effect, it still creates limits. So I think, generally speaking, you wouldn't expect too many sidechains because you want to put multiple assets in a single sidechain so that they're easier to contract against. So you might more expect chains that are specialized. So we talked about zero cache sidechain, snarks sidechain, something different and specialized for the purpose.
What would you consider to be the ideal storage that augments the chain, computing on the chain, more specifically
the big chain technology.
Which technology? Repeat the last word.
Big chain DB, based on basically Cassandra and Federated challenging response.
So I don't know about that particular chain. I mean, there are some chains that are, the data is not in the chain, they're just timestamping data that's kept outside. So that's a different model. It's also possible. I don't know if that's the way that that particular chain that you described works.
Questions?
So something like Bootstrap, does that have kind of the ether or gas kind of overhead?
So the native currency on the chain becomes Bitcoin. So Bitcoins are moved from the Bitcoin chain into the Bootstrap chain, and then those are used to pay for contract execution to make payments. So it basically brings the functionality of Ethereum into the Bitcoin, like makes it interoperable with Bitcoin, and means that if you're holding Bitcoin, then you can use those features, and if if Bitcoin is, let's say, more stably priced and you don't want to speculate, you can just keep using Bitcoin.
So I thought, before this talk, I thought the sidechains would be a solution to scalability. Now I have the feeling that most nodes would mine all chains. It's probably not a solution to scalability, or it's more an option to make soft forks easier, or to make it more fluent for the network to agree to one soft fork or to one extension.
Yeah.
Would you share this view?
Yeah, I mean, it's more about extensibility, not so much about scalability, but we can, the situation with the main Bitcoin chain is it's got to provide, it's a one-size-fits-all solution, so it's got to provide, very high value transactions and very small value transactions, and so it won't be optimized for one or the other. It will be some kind of compromise. And at least if you did have, let's say, two chains, one could be the normal Bitcoin security model one, another one could be low value transactions. You just got some deployments. Maybe there are only 2 or 3 calls and they have high speed connections between them. Everybody lines through them. And that's a pretty dangerous security model for actual Bitcoin, but for low value transactions, if it gets shut down or the nodes go offline or something, well, you lose $10 when somebody brings up a hole on you, put some money to that and so you can make more aggressive trade-offs. But still, it doesn't change the scalability picture, which is that you've got this ON squared broadcast between the 4 nodes, and so that's why Lightning is more interesting, because Lightning and Jupyter microcodes, the actual transactions, once they're set up, flow like TCP, so point to point. So the transaction latency and the amount of the number of transactions you can send per second is really limited by the network link speed in the CPU, so it could be very, very high. And there is reasonable evidence to suggest that Lightning will actually be able to recirculate funds in the network quite effectively, so that they won't have to, if you eventually exhaust the channel, you have to go and set up a new one. But there's good evidence to show that that will recirculate. So an example would be if you're buying Bitcoins and they go straight onto a channel and you're using it to buy coffee at Starbucks, and eventually you exhaust the channel. So you don't want each month to go create a new one. So what you can do is you would assume Starbucks is going to sell them on the exchange, and then they're going to go onto the Bitcoin network, and then you're going to go buy them in the channel to get set up again. But if you think about it, what would make more sense, and so what they would probably do for economic reasons, is the exchange will realize it can move coins more cheaply by also being on the Lightning network. And then you will basically Starbucks will sell the excess plain cash bitcoins. So Starbucks will sell them to the exchange, and you'll go buy them from the exchange. So they'll just go around in a circle and just stay there. They can be indefinite potentially. So it's just down to the sort of balance of flow of payments.
Let's take one more question.
What will the script look like for the two-way passing? How will the script suspend the founder and also be animated?
So what does the script look like? So, okay, it's a good question. So, okay, never mind. We don't understand. But so the point of the script is it's saying that these coins are, so they can't be spent. So there's a script which allows spending, and what the script says is that you have to present it with this compact proof that the coin has been destroyed effectively in the sidechain. And then there's a maturity period where that can be cancelled. So this is all written into the script. So it's a quite complicated script. And if you want to see the detail, so it's in the white paper, but there's also the implementation of it in the sidechain elements code base. So even though the updates have not been added to Bitcoin, an example implementation is there that shows how to add it. And it's a complicated script, quite a large script, that relies on these compact proofs of work from the sidechain. So they're not able to understand that proof format. That's the main thing.
Sasha, let's make one more question.
The last one.
Last one.
I have one question about the does the amount, like the size of the output, has that to be the same, or is it also possible that, let's assume I peg one Bitcoin and then somebody else pegs one Bitcoin and then on the sidechain we transact and I end up with the 2 Bitcoins. Do I have to split them again, or can I claim them?
So there doesn't have to be a cryptography. Basically, coins are being put into the sidechain, and what guarantees the security is that the main Bitcoin chain will only allow, if there are 100 Bitcoins that went in, the maximum of 100 can come out. So if the sidechain is very experimental and it has a flaw, well, that's the extent of the risk, right? So only the people who opted into an experimental chain have funds at risk when Bitcoin is not exposed. So that was a little part of your question there, right? So
if I have two out, I mean.
Oh yes, right. So and actually, it doesn't really care which transaction. So there's just an amount that's gone in, and if you want to take some amount out, you just find some that haven't been used and take them out. And so the current owner of them could be somebody different, and they could have been combined. So it's just an amount, and you're referring to a not yet returned transaction in history that connects. So it's not, there's no need to coordinate which one to take back or anything like that.
So please join me in thanking Adam. We have, as you heard, 2 other blockchain events this month. So we talked about Lightning Network. So Elizabeth Stark and others will be speaking at Pivotal, and then one from Quanalytics, a representative from the DOJ will be talking about compliance and risk related to that. So thank you for coming.